updated through Aug 25. If I had to capture the U.S. economy's 2025 story in one line, I'd say, it bent, didn't break, and is now trying to land softly on a short runway. We began the year with a stutter, growth. Slipped in Q1 as tighter financial conditions and policy uncertainty bit, but momentum. Revived in Q2. That rebound wasn't a sugar high from one-off factors, it came from still resilient consumer spending and a gradual easing of supply frictions. Even so, the expansion feels different from 2021-2023. Less adrenaline, more careful footing, and a constant awareness that one bad data print can change the mood on Wall Street and Main Street alike. Inflation is the hinge of this whole narrative. Headline price growth has cooled into the twos, which is psychologically important after the bruising run-up of 2022-2023. But the stickiest pieces, shelter and several insurance categories, have not fallen as quickly as the Fed would like. I think we're past the phase where central bankers fear an entrenched spiral. We're in the phase where they fear a plateau. That's why the policy tone has shifted from higher for longer to patient and ready to cut if the labor market weakens. In my view, 1 or 2 quarter-point cuts before year-end are more likely than not because the Fed is chasing market cheer, but because the risk balance has tilted toward employment without giving up the inflation gains already banked. Jobs are the second pillar. The labor market has cooled gently. Payroll gains have slowed. Revisions have taken some shine off prior months, and unemployment has drifted a bit higher. None of that screams recession. It reads more like a system settling from red-hot to merely warm. Wage growth has downshifted too, which is consistent with a sustainable disinflation path. The risk here isn't a sudden collapse in hiring. It's the slow drip of softer hours, softer openings, and softer confidence that can sap consumption over time. I'm watching the breadth of job creation, and the duration of unemployment spells more than any single headline number. Consumers remain the reluctant heroes. They are still spending, helped by real wage gains and a strong asset backdrop, but they don't feel fantastic about it. Survey measures of sentiment are conspicuously weaker than the hard spending data would suggest. That gap has been a feature of the post-pandemic economy. Prices cool on paper yet feel stubbornly high in daily life, especially for rent, car insurance, and services that you can't easily substitute away. My take is that vibes matter because they set the tone for discretionary outlays in the fall and holiday season. If gasoline, rents, and insurance nudge sideways or down, the mood could brighten. If they flare again, via energy shocks or tariff pass-through, the vibe tax returns. Housing is an example of this uneasy normalization. Mortgage rates have come off their peaks, inventories have improved, and prices are no longer sprinting. That's good news for transaction volumes and for builders who finally see a path to clearing backlogs. Yet, affordability remains historically tight, and the reset is uneven by region. I don't expect a housing-led upswing, but I do expect housing to be less of a drag than it was at the height of the rate shock. In practical terms, more sideways with pockets of strength than boom or bust. Policy is the wild card. The reorientation toward higher and broader tariffs is already visible in customs receipts and in the way firms talk about 2026 planning. Tariffs are a tax. Some of that cost will show up in prices, some in margins, some in rerouted supply chains that are less efficient in the short run but perhaps more resilient in the long run. I don't buy the argument that tariffs alone will derail the expansion, but they do complicate the last mile of disinflation. If the Fed is trying to nurse core services down, extra import frictions are helpful. The flip side is fiscal arithmetic. Higher tariff revenue trims headline deficits at the margin, though it doesn't change the long-term debt trajectory in a material way. Net-net, I see policy as mildly growth negative and mildly inflation positive versus a no-tariff baseline. Financial markets have voted with their feet for a soft landing. Equities at or near highs, credit spreads contained, the dollar and yields reacting more to each data print than to any grand narrative. I don't think that's irrational. If inflation is drifting toward the high twos and the Fed can start normalizing policy without panic, then earnings growth, helped by AI-linked capex cycles and still solid consumption, can carry the tape. But this is the sort of calm that depends on the next 3 weeks of data, a hot CPI in September or a disappointingly weak jobs report could flip the script quickly, because positioning has leaned into the cut soon, but not because things are bad sweet spot. Where does that leave the outlook? My base case is a bumpy soft landing. Growth slows from 2024's pace but avoids recession. Inflation grinds toward 2.53% year-over-year by December. Unemployment edges a bit higher but stays close to 4%, and the Fed delivers a cautious first cut with a second one dependent on incoming data. I put a smaller but real probability on a choppy plateau, in which tariffs and sticky services keep inflation from falling further and the Fed becomes even more incremental. The downside scenario: an unmistakable labor softening, a sentiment slide, or an energy shock that reheats prices while spending fades, exists, but it would likely be met with faster policy support than in prior cycles, precisely because officials have stressed the employment side of their mandate. 2 practical points follow from this view. First, for businesses, inventory discipline and supplier diversification still matter, not because a crisis is imminent, but because lead times and tariff schedules are unpredictable, and the demand profile is uneven across goods and services. Use the soft indicators, PMIs, hiring plans, and retail foot traffic to adjust Q4 and early 2026 plans rather than waiting for lagging data. Second, for households, the mix is improving but not comfortable. Real incomes are better, mortgage rates are a bit more forgiving, and the job market is still offering opportunities. Yet the lived experience of price levels means budgets feel tight. Building or rebuilding a cash buffer still makes sense at this stage of the cycle. Stepping back, 2025 has been a lesson in economic resilience. The U.S. has digested higher rates, shifting trade rules, and the tail end of an inflation shock without losing its footing. That doesn't guarantee a smooth finish. It does suggest that the default path is not a recession, but a slower, steadier expansion with policy gently easing as risks to jobs rise and price pressures ebb. Over the next month, the trio of the August jobs report, the August CPI, and the September Fed meeting will do more than fill headlines. They will tell us if this soft landing is truly touching down, or if we have one more loop around the runway. In my judgment, the wheels are down, the flaps are set, and the pilot is ready to tap the brakes, just not to slam them.